Hey guys, what's up? I'm Erin and welcome back to the channel. When we put our money away for the future, whether that's a midterm goal or a long-term goal, we tend to have this question that pops up into our mind, which is, how much will this eventually be worth? How much could it grow to if left invested for 20, 30, or 40 years? And the answer depends on a couple of factors. The most important thing is what you choose to invest in. On the one hand, just for the sake of argument, let's say you choose to invest conservatively. Maybe you put your money into a money market fund, which strictly invests in government-backed securities. Or maybe you invest directly in T-bills, which are government-backed securities. Currently, these types of investments would pay you a little bit north of 5%. Now, these investment options are very conservative. The intent with these investments really is to preserve your wealth, not necessarily grow it over time. So these really wouldn't be a great long-term investment if the goal is to grow your net worth or to grow your wealth. Sure, they're currently paying around 5%, but historically they have paid much lower rates of return, especially during periods of lower inflation. On the other hand, you could have a more aggressive investing style. Maybe you go all in on stocks, or maybe you go all in on index funds that track perhaps say something like the S&P 500. And the first portion of 2024 has been very good to the stock market. In January through July, this type of fund has returned a little bit over 15%. Now, you could think of investing in treasury-backed securities and strictly in stocks as being two ends of a spectrum, one being conservative and one being aggressive. And you don't really have to fall on either end. You can fall somewhere in between. A lot's going to play into this. Maybe your age, your family dynamics, your risk tolerance. There's a lot of factors that will influence where your risk tolerance is. The general rule of thumb is the younger you are, the longer the investing time horizon ahead of you, the less dependence you have. Maybe you're not married, or maybe you don't have children, the more aggressively you can be invested. You have less on the line at this point. You have a longer time horizon for your portfolio to weather the ups and downs that naturally come with an aggressive investing style. For instance, if you had $50,000 saved up for a down payment on a home, and you're looking to purchase a home within, say, the next 2 years, this is not money that you would want to have aggressively invested. You wouldn't want to just pop this money into an S&P tracking fund, because who knows how it's going to perform over the next 24 months. Yes, in the past few months, it's performed incredibly well, but how it does in the next couple months, that's anyone's guess. However, if you're talking about investing for your retirement, and that's, say, 40 years down the road, well, that money can handle a lot of ups and downs over the next 40 years or so. So how you invest absolutely matters. The more conservatively you invest, the lesser the rate of return you can generally expect. The more aggressive you invest, the greater return you can generally expect. A lot of investment companies and employer-sponsored retirement plans tend to push target date funds as a way to help answer the question for investors of, what should I be investing in? Target date funds offer a more balanced approach, and over the course of an entire career, follow what's called a glide path. Early on in your career, when retirement is several decades away, the funds invest more aggressively. Think in equities and international markets. Then as you get closer and closer to retirement, these funds become more conservative in nature. A lesser percentage of that portfolio is allocated towards equities and those international markets, and instead it gets allocated more towards, say, government-backed securities as a way to create a more stable fund. I think target date funds have their pros and cons. If you're an investor who wants to be more actively involved in your portfolio and build a portfolio that's more individualized to you, I think there's absolutely a way you can do this better by building a portfolio of your own funds and not using target date funds. But if you're an investor who wants a more hands-off approach and you want something that's just simple, set it and forget it, I think target date funds can be a great option. It just depends on what you're looking for out of your investments. But the thing to keep in mind when it comes to target date funds is that they do generally follow the rule as the younger you are, the more aggressively you can be invested. As you get older, they switch over to being more conservative in nature and adopt a more wealth preservation mindset when it comes to this portfolio. One of the biggest arguments you hear when you run long-term projections over, say, a 10, 20, or 40-year period is, yeah, but what about inflation? And yes, those arguments do have merit because inflation absolutely does matter. We can consider the fact that $1,000 25 years ago in 1999 is more like having $1,900 today, or that having $1,000 50 years ago in 1974 is more like having $6,400 today. So if you rewind 25 years, you need a dollar amount that's almost double what it was to have a constant level of purchasing power. If you go back nearly 50 years, you need a dollar amount that's almost 6.5 times what it was to have a constant level of purchasing power. So when you consider it from this perspective, it's easy to see why so many people are quick to shout out, "You forgot to factor in inflation." Yes, inflation matters, and it should absolutely be factored in. That's just smart financial planning. The wonderful news is it's fairly easy to factor in inflation in these long-term projections. There's a formula for this, which looks a little something like this. So if I were to run an example here and plug in some numbers, I might suggest putting in a rate of return of 10% based on the stock market having a long-term rate of return of 10% and a rate of inflation of 2%. Plugging in those numbers into the equation, we get an inflation-adjusted return of roughly 7.8%. So essentially by using a reduced rate of return, this reduced rate of return factors in inflation. Then when we go and run our compounding calculation, the number that we get as a result is inflation adjusted, presented in today's dollars. For instance, if I wanted to look at what a $50,000 investment left alone would grow to over the course of 4 decades, using an inflation adjusted 7.8% rate of return, I see that it could grow to $1 million. That $1 million figure is presented in today's dollars. So if you go 40 years down the road, that number very well may be larger. But if all pans out according to this calculation, you would have roughly the purchasing equivalent of $1 million in today's dollars. Alternatively, if we were to use a 10% rate of return, we would get a number north of $2 million, and that would be a non-inflation adjusted dollar amount. And while there is that specific formula for inflation-adjusted rate of return, you can do a quick calculation or the poor man's version if you don't want to do these specific numbers. You could use the rate of return minus inflation, and that'll give you a rough ballpark number. So in this case, it would be a 10% rate of return, traditional stock market return, minus inflation of 2%. That would give you an 8% rate of return if you wanted to use it. Again, this is just going to be an estimate, not a specific figure, but anytime we run these numbers, we're going for estimates. All of these numbers are subject to change, and you should use the numbers for your calculations that you're most comfortable with. Yes, the stock market has historically returned around 10%, but there's no guarantee that it will do that going forward. There's been times in our history where inflation has been less than 2%, times where it has averaged around 2%, and times where it's averaged more closer to 3%. So all of these numbers are subject to change. There are no guarantees. All of these estimates are just that. They're estimates. Outside of inflation, taxes are a huge consideration. The wonderful thing about Roth accounts is that you don't really have to factor in taxes. The contributions you make to your Roth account are made on a post-tax basis, so money you've already paid taxes on. Then that money gets to grow tax-free, and then fast forward to your retirement years where you get to take your withdrawals without having to pay taxes. So you don't really have to worry about taxes on the Roth accounts. On the other hand, if you have traditional retirement account types, taxes are absolutely going to be a consideration. And just how much goes to taxes really depends on the tax bracket you fall into. In the US, we have a progressive tax system, meaning that lower levels of income are taxed at lower rates and higher levels of income are taxed at higher rates. In 2023, the typical American household had a net average tax rate of 24.2%. So that includes taxes paid after any credits, deductions, and exemptions. Now, of course, averages don't give us a very clear picture of what is happening on the individual personal level for any one person, but it does give us a good estimate to work with. So if you go into retirement with a traditional retirement account, a rough estimate could be that about 24% of this account's value would be paid out to taxes. Meaning that if you had $1 million in a traditional 401k, after taxes, you would really have about $760,000 to work with in terms of spending power. Certainly, there would be wiggle room with this. It depends on how you take your distributions. Maybe you follow an RMD schedule, and I did recently do a video on RMDs. I'll link it here and down below if you're interested in learning more about it. But there are things you can do to influence this number, but ultimately, taxes do have to be paid. And when it comes to taxes, taxes are absolutely worth careful consideration. On the one hand, I think Roth accounts are very alluring, simply from the stance of once you get to retirement, you know that every single dollar within that account is yours to use. You don't have to go siphoning off a portion for Uncle Sam. But that doesn't mean that the Roth is always the best choice. For instance, let's say in your working years, you're an incredibly high income earner. Say you find yourself in a high tax bracket and you know once you retire you will be in a lower tax bracket. It could very well be that a traditional retirement account is a better choice for you, because in that case it would result in an overall tax lifetime savings. However, if you end up in the same exact tax bracket in your working years as you do in your ultimate retirement years, well, then it doesn't really matter which account type you choose, whether it's the Roth, whether it's the traditional. In the end, you'll pay the same amount in taxes. Taxes matter, and no matter what, we have to pay them. When it comes to what you can grow your portfolio to, the main factors are what you're investing in, the impact of inflation, and the impact of taxes. What matters most is what you end up with in the end. And no matter what, there's a level of uncertainty in all of this. How will equities perform in the long run? Similar to how they've performed in the past? We're uncertain of what inflation will look like or what taxes will look like in the future. When we're running our projections, it helps us to prepare for the future. But no matter what, there's always going to be some level of uncertainty in all of this. The best thing you can do is get invested and stay invested for the long term. How do you factor these items into your projections? Let me know your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. To grow your wealth. Now, these investment plan on a fund that tracks, say, invested, simply from the stance of your aggressive you invest, greater